Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for September 2023. Now, since our last update in July, spot tanker rates have fallen quite considerably to their lowest level since the first half of last year. And that's really due to two main reasons. Firstly, just normal seasonality, and secondly, supply cuts by the OPEC Plus group, in particular Russia and Saudi Arabia. So starting with seasonality, it's important to note that spot tanker rates typically do fall during this time of year, and Q3 is typically the weakest part of the year for spot tanker rates. And that's because after the summer demand period, we see refineries usually go into maintenance during the fall, and during that time they have less demand for crude oil. So we see the number of cargoes decline. However, with refineries now looking ahead to the winter demand season, we should in the next few weeks start to see refiners procuring cargoes again for the winter, and that should start to add to tanker demand. And in fact, in the past few days, we have seen activity start to pick up. Perhaps the biggest reason, though, that tanker rates have fallen over the last 2 to 3 months are the supply cuts from Russia and Saudi Arabia. So starting with Russia, Russian crude oil exports peaked in May at about 3.9 million barrels per day. Now, since then, they have fallen to about 3.1 to 3.2 million barrels a day in July and August. And that coincides with announcements from the Russian government that they were going to cut crude oil exports in order to support OPEC policy. However, we think that the real reason Russian exports have gone down is more to do with their own domestic demand requirements and refinery throughput. So during the spring, when Russian refineries were undergoing quite heavy maintenance, there was more crude oil available for export, so the exports went up. And then during the summer months, when fuel demand in Russia was high, more of that crude was kept at home to put into their own refineries. So that's why crude oil exports came down. Now, as we head into the fall, we see that refineries are going back into maintenance, and we do expect that Russian crude oil exports will recover. In fact, during the first half of September, we're already seeing a tick up in Russian crude oil exports, averaging about 3.3 million barrels a day. And we think that will continue over the next few weeks and months, which will give support to Aframax and Suezmax demand. Now, turning to Saudi Arabia, the Saudis implemented voluntary supply cuts of 1 million barrels per day back in July. And that came on top of a more coordinated OPEC Plus supply cut back in April. So we've seen that Saudi crude export volumes have fallen quite significantly from a peak of about 7.5 million barrels a day in April down to about 5.5 million barrels a day in August. And that really has had a negative impact on tanker demand, particularly on the VLCCs, which has then put pressure on the mid-sized tankers as we've seen more VLCCs competing for cargoes, especially in the Atlantic Basin with Suezmaxes. Now, looking ahead, Saudi Arabia has said that they will keep these supply cuts in place through to the end of the year. However, they're going to revisit that on a monthly basis. And what we've seen in the last few weeks is that Saudi supply cuts are now starting to have the desired effect in that crude oil inventories around the globe are dropping quite rapidly, and that's giving support to crude oil prices. Brent crude oil recently hit $95 per barrel, which was the highest since last November. And so, looking ahead, we think there's a good chance that Saudi Arabia might revisit their production policy and add oil back into the market before the end of the year. And so we think there's a good chance that rising Saudi volumes into Q4, coupled with rising Russian crude oil exports, should give some support again to crude tanker demand and therefore spot tanker rates. So we do think that we're probably at or just past the low point in terms of tanker market seasonality, and we look ahead to another strong winter tanker market emerging in Q4 and Q1 of next year. Now, just looking a little bit further ahead to 2024, the forecast for oil demand next year is that we'll see about 1 million barrels per day of growth. That's from the IEA, which is a slowdown from oil demand growth this year of about 2.2 to 2.3 million barrels a day. And that slowdown is because, there's some headwinds in the global economy, which might impact oil demand next year. And also, we won't see any more post-pandemic rebound effects like we had this year with China coming out of lockdowns. However, the real story for the tanker market is on the supply side of the equation. And the fleet supply story continues to look very positive for the next 2 to 3 years. We have had an increase in tanker ordering during this year, with orders for about 57 Aframaxes and LR2s and 39 Suezmaxes. But when you look at crude tanker ordering on a deadweight basis, the amount of orders we've seen this year is in line, pretty much in line with the 10-year average. Furthermore, shipyards now are fully booked out well into 2026. We don't think there's any more capacity for 2025 deliveries, and the yards are about 50% full for 2026, and some yards are even taking orders now into 2027. So with this combination of a fairly small order book, full shipyards for the next 3 years, and an aging tanker fleet, we think that fleet growth will remain very low for the foreseeable future, and we are forecasting close to zero fleet growth in both 2024 and 2025. So that should keep tanker fleet utilization very well supported and give us confidence that we're going to see a continued strong tanker market for the next couple of years at the very least. So that's our tanker market update for September, and we'll speak to you again next month.